if you think about going to a wedding and you're an investor that has not piled into the bond market from your money market fund allocation, you might have missed the cocktail hour, but I don't think you've outright missed the reception at this point. Welcome back to another edition of the Blue Chip Partners Quarterly Edge, which essentially serves as an outlook for the following quarter in financial markets and beyond. Just as recent times, I have Dan Seder here, who is going to prompt me with a few questions with regards to financial markets.
Daniel, here we are. We're on the brink of a loosening of monetary policy. You have the Fed poised to cut rates, and that's going to have a big impact on both stocks and bonds. So maybe start with walking us through the impact that this might have on stocks from a sector perspective.
The interesting thing is that the returns across sectors in the domestic equity market, as we look at previous rate cutting cycles, they're very different. So there is a fair amount of dispersion between the 11 GIC sectors. And specifically, when you look at some of the top performers, there's some of the more defensive sectors. So what I will call out first is that for the year following a rate cutting cycle's beginning, at least going back to 1995 up until now, consumer staples and healthcare have been the top performing sectors for the following year.
Wow,
and
that's surprising.
Yeah, and I think if you step back and think about it, though, it does somewhat make sense. So if you think about why rates are being cut to begin with, that's most likely because the economy needs some stimulation. The economy has slowed down for some reason. It's been a different reason each of the rate cutting cycles between 1995 and today. But what is not different is that the economy is struggling. And so in that type of environment, it shouldn't be overly surprising that you have two traditional defensive sectors in consumer staples and healthcare act as top performers for the year following the first rate cut on average.
Makes sense.
Some other observations, I would say you have, again, thinking about broader kind of implications here, rates are being cut. The Federal Reserve is stepping in. What does that mean for the bond market? The bond market is bearing less interest on, the potential investments that individuals are making. And so as a part of that, I think the common notion is that the interest rate sensitive equity sectors, call them the bond proxies, utilities being most likely the first one that comes to mind, a lot of folks would think that they are beneficiaries. And while that's not incorrect, what the data would show you on average, again, going back to 1995, is that utilities receive a bump right at the immediate onset of a rate cutting cycle. But thereafter, most likely as the economy starts to strengthen, investors kind of ditch utilities, most likely in favor for some of the other more balanced sectors.
Yep.
And I think this is timely because I can draw some comparisons relative to today. So if you look at what's being shown on the screen, you see that utilities perform well for the first few months after an initial rate cut on average, but thereafter they fall off. Well, what you're not seeing is what's further left on this chart, and that's the period before rates are actually cut, but rate cuts are being expected by the market.
Yeah.
So, for example, this year, utilities are the top performing sector in the S&P 500. Right? That's because investors are expecting those rate cuts and expecting market participants to pile into that sector and trying to get out ahead of that.
Yeah, and I've always heard the market is, it could be 6, 9, 12 months ahead of the news. And so you're seeing a movement in price and utilities ahead of the news.
Yeah, that's right. And so while it's not, I'm not sounding the alarm on utilities right at this juncture, I think there are other tailwinds at play. I mean, we've talked maybe not, I guess, in this forum and then on our podcast and elsewhere on the kind of structural changes and benefits that are happening to the utilities sector with regards to power consumption and all that. But what I will tell you is just that on average in rate cutting cycles, the time to own utilities is before rates start getting cut and immediately when rates start getting cut. But start to seek other opportunities and be aware of valuations and potential frothiness in that sector as you progress through the cutting cycle.
Yep. Makes sense.
So the other kind of element to this is there's obvious underperformers in a rate cutting cycle. And what's interesting is that the two biggest underperformers on average in rate cutting cycles going back to 1995 are more or less what the textbook would kind of dictate. And so financials and energy are those two sectors. If you think about financials, we'll just use banks as an example. So what happens when rates are going up? When rates are going up, banks can make more money on the dollars they're collecting from individuals or institutions they've loaned money to relative to what they have to pay out to depositors. And so that spread can be a lot higher in an interest rate environment that's rising or structurally higher.
Yep. So for our listeners, in the most recent environment where mortgages might have been north of 7%, if banks were taking on deposits and paying those deposits maybe 10, 20, 30, 40 basis points, but then lending those dollars out in the mortgage market at 7%, there's a massive spread between what they're paying the depositors and what they're collecting from the loans that they're making in the form of a mortgage.
It's absolutely right. And so what happens when interest rates start to taper off? That spread starts to compress, and that's a major portion of profitability for banks.
Yeah.
So you can start to see the environment be a little bit more challenging for those types of businesses. The other component of it is, again, these banks and financial institutions are built on lending. And so as you see the economy slow down, whether it's due to just lower levels of consumer spending, that's going to drive lower levels of manufacturing activity and research and development. That just means less loan activity. So from an economic perspective, it's not surprising to see financials underperform on average as you kind of start to get into that rate cutting phase.
And less economic activity probably translates into the energy sector as well.
Yeah, and you hit the nail on the head. So same kind of argument applies here. Energy is well thought of as kind of a late cycle play. And as we're looking at rate cuts, that's kind of looking as we emerge into a new cycle. And so with energy, the story is the same as financials, where there's less consumption, probably less manufacturing activity, and overall just a lower need for resources. So I think that it's not overly surprising to me to see these two sectors act as underperformers on average in rate cutting cycles. It's not to say we're going to go completely naked to these sectors. I still think you can find quality businesses within them, whether it's, whether it's capital market related firms in financials or payment processors that are a little bit more resilient and less reliant on economic cycles than banks, for example.
Yep.
But you do need to be a little bit more cautious and a bit more selective as you're doing your bottom-up analysis.
Makes sense. So let's think now more broadly. So we've talked about the sectors within the markets, and a lot of times when we talk about sectors, we're talking about large companies. How does a loosening of monetary policy or the prospect that the Fed is going to cut rates impact smaller companies? So when we think of not the big names that we're always hearing about on the news, but some of the smaller capitalization companies, what's the impact on those?
Well, I would start this by saying we don't like to be overly tactical at Blue Chip. We pride ourselves on being long-term investors. And as a part of that, we're trying not to make knee-jerk reactions or short-term decisions. Yeah. Now, what I would say is that at the asset class level, there are certain times when certain asset classes should outperform. And there are also certain times, certain environments where specific asset classes should not be expected to outperform. Take, small caps in a high or rising interest rate environment. Smaller businesses are just more prone to declining profitability due to higher interest expenses in a high and rising interest rate environment.
It's harder for them to borrow money. They're spending a lot more to borrow. When they borrow, it's costing them more, so their profitability is down.
Right. So you just see interest expense representing a much larger component for small businesses relative to large businesses.
Yeah.
The script is somewhat flipped as you enter this lower interest rate regime. And you can see how in this type of environment, small caps might start to become a little bit more attractive. The other thing I would tie into this is I mentioned before that the Federal Reserve is generally going to be late. So that means constraining the economy too, far down the road after the economy has boomed and kind of stimulating the economy too late into the kind of softening phase.
Yep.
And as you think about that, we have seen some economic softening, and I'm not going to say the Fed is overly late this time, but the fact of the matter is, as rates start to get cut and tamped down, it may not be that long before the economy bottoms out and actually starts to show signs of improvement. So that's another very conducive environment for small caps. If you have lower interest burden and an improving economic environment, that's a very strong argument for small caps. And actually, if you look back through rate cutting cycles going back from 2000 until today, small caps have meaningfully outperformed large caps, at least on average. And I think, again, we don't want to be overly tactical, but the whole point of saying all this is that you don't need to structurally own an asset class that you expect to underperform, or an asset class that has historically underperformed in similar economic environments in the past. I'm fine starting to think about small caps right now because I'm expecting, again, as the economy bottoms and kind of runs forward and interest burden starts to decline, small caps historically have shown some fairly attractive outperformance relative to large caps to the tune of 12% excess return for the year and a half following the first rate cut on average since 2000.
Yeah, what I love is that our investment committee is open-minded to other opportunities or possibilities within the market.
Yeah. And, again, it's one of those things where you just have to stay in tune with it, right? Because even though on average, we've seen small caps on an equal weighted basis outperform large caps on an equal weighted basis for the year and a half following the first rate cut on average, that doesn't mean this cycle will play out exactly as we've seen the average over the last 25 years be. So you just need to stay on top of things. And I still would emphasize, even in small caps, a more quality-centric allocation instead of getting a type of portfolio that ends up whipsawing you around.
Yep. Sounds great. Now, Daniel, we talked about the Fed cutting rates. We talked about equities, both from a sector perspective and then more broadly, large cap versus small cap. Before we transition on to bonds, was there anything else that we missed on the stock side?
Nope, I don't think so. What I would say, though, is I think the common notion is high valuations, the Magnificent Seven, your tech giants have run, the market's overvalued. I don't necessarily think that's the case. There's been plenty of dislocation that's happened this year. There are plenty of fine businesses that have been somewhat left behind in the rally. So the broadening out that you saw in the equity market for the first 3 months did not happen for more or less the 5 months that followed. But we've actually started to see that come back to the forefront a little bit. And I continue to expect that to be the case, especially if we get continuing softness economically.
Yeah, and we can all argue that broadening of the market, not having 7 big tech stocks lead the market is probably a healthy thing. I think that's a good thing overall. Okay, great. Let's move on to our last topic, which is taking a trip down memory lane, going back to what you wrote about and we spoke about in the first quarter of 24's Quarterly Edge. So let's do a recap of the greatest investment opportunity in a decade. So let's talk about that.
Yeah. So if you haven't watched it, I would encourage you to do so. The Quarterly Edge that we put together for the first quarter of, or maybe it was the second quarter technically of 2024.
Earlier in 2024.
Yeah. I called the bond market on a domestic basis today a once in a decade investment opportunity.
Once in a decade. That's what I was looking for.
Right. And so, part of the reason behind that is just because all of the signs were pointing to some massive tailwinds for the bond market. That included currently high interest rates, great potential for lower interest rates going forward, which can be beneficial for prices of debt instruments. And so what we've seen since then is a massive rally in the bond market to the tune of about 7%, as represented by the Bloomberg U.S. Aggregate Bond Index, between the months of April and close of business yesterday, which was September 16th. So the whole argument there was take advantage of the higher rates, get exposure to potential price appreciation as well, and your total return should be good. So if you look at the value proposition of the bond market versus money market funds over that period, the actual kind of yield or the income distribution from the domestic bond market as represented by this index was about 4%, but the total return was 7%. So you can see that there was 3% roughly worth of price appreciation. Now, the argument against this was, why would I do that when I can collect, 5+% on money market funds? My argument was still, look, you're giving up some level of income distribution on a monthly basis, but you're getting it more than made up for, or you're being more than fairly compensated by the prospect of price appreciation.
Yeah.
And that has been the case.
So there's two things. One, when I think about the price move since April, it reminds me of the comment you made on utilities, where price reacts before the news. And so we saw a price movement. But now that price has moved, and you can see on the chart the discrepancy between the money market total return and total return on bonds, is it too late? I mean, is it too late now for investors to get on the bond train from money markets if they're sitting in a money market position?
The short answer is I don't think it's too late. The value proposition is still there, but it's just a little bit different. And so I can use the analogy of, if you think about going to a wedding and you're an investor that has not piled into the bond market from your money market fund allocation, you might have missed the cocktail hour, but I don't think you've outright missed the reception at this point. And so what I'm saying that is because you still are getting a good, attractive yield opportunity in the bond market. And that's especially important to consider when you think about the direction of money market fund rates going forward. We've talked about what happens to money market fund rates in a declining interest rate environment. I think the best way to look at that is to look at some of the securities that are basically comprising these money market funds. And that's very short-term Treasury bills. And so if you look back through history, on the screen, I'm just showing a 10-year snapshot of the U.S. 3-month Treasury bill and a money market fund. You can see that the current rate in the market for a 3-month Treasury bill kind of precedes money market fund income distribution rates by 3 to 6 months. So if you look at what's happening now, 3-month T-bills are declining. From a rate perspective, that's because the market is looking forward to the Fed, which is poised to cut rates. And what's going to follow that? Deteriorating money market fund income distributions. So I don't think that you've entirely missed the party. And certainly if there is further economic softness, then you still have an argument for price appreciation in bonds as well. But I think that taking advantage of yields where they are today, potentially locking them in a collection of bonds or some smattering of debt securities, I think still makes a lot of sense. And if you look out over the next 2 years, still very well may provide you with a more compelling income proposition overall relative to money market funds. And I still believe that it'll provide a total return proposition that's well over and above money market funds, from here.
I agree, because this is the beginning of the loosening phase. And so I think right now futures have the Fed cutting maybe up to 10 or 11, 25 basis point cuts over the next, call it, 12, 13, 14 months. So it's beginning now. And that doesn't mean that that's exactly how it plays out, but that's how the bond market is pricing the Fed to cut rates moving forward.
Yeah. And, let's be very clear, when we look out over the next year, to have 10, 25 basis point rate cuts priced in, or expected, I should say. I mean, I think that's crazy.
And just to clarify, so 10, 25 basis point cuts. So we're talking about 2.5% off a Fed funds rate today of 5.5%.
Right. And so, I mean, in that scenario, your money market fund rate over the next year and a half goes to 2.5, right?
Right.
And so that's just another supplemental argument to what we just talked about. Now, what I would say is that, again, I don't think we're ever going to get to that level. I mean, this is the same futures market that coming into this year expected 6 to 7 rate cuts.
Right.
We've kind of clawed back, and the market's now expecting closer to 4. But whether or not that comes to fruition, I guess the point is, I don't think 10 is going to happen, but I don't think 10 has to happen for this whole bond argument to work.
Yeah, the point is that money market rates are coming down, and the lowering of yields provides an opportunity for capital appreciation in bonds. And so if you can lengthen duration, buy a bond and lock in some duration, that's going to suit you well in that, call it safe haven portion of the portfolio.
Yeah. And the thing is, I think people would say, oh, I've missed the boat because Treasury yields have fallen so dramatically that now the 10-year is at 3.6%. I think I definitely missed the boat. I think this is about a lot more than just Treasuries, especially if you kind of venture out and look through some segments of the corporate market. You still have really high quality paper that is providing you with a spread above treasuries that should be viewed as pretty attractive. And keep in mind, even if we get some economic softening, if we were to go into a recession, I don't view it as being overly punishing. And so some of these businesses that are issuing the high quality paper that I'm talking about, I still think the value proposition is maybe even better there than it is in the treasury market.
Yeah. That's interesting.
Yeah.
Great stuff. Daniel, we talked about the Fed cutting rates. We talked about stocks. We talked about bonds. Anything else that we didn't cover?
Nothing else today, Dan. I appreciate you joining as always.
Yeah, thanks for having me.
Okay, that's a wrap on another edition of the Blue Chip Partners Quarterly Edge. Please be sure to tune in on our YouTube channel, Blue Chip FM, for any other updates. That includes our weekly podcast. And check out our website for some very interesting blog posts. Thanks for joining us. See you next time.